I'm here today with Brian Skelly, mortgage banker for William Ravis Real Estate. And I thought I'd do something different today. I've been getting a lot of questions about how COVID-19 and the lockdowns have impacted on mortgages in real estate. So I thought that I would invite Brian to sit with me so that I could ask him some questions and we could get answers. So Brian, thank you so much for joining me today. It's such a pleasure.
It's great to be here, Diane. Thank you for having me.
Oh no, it's totally my pleasure. So let's get right down to it. So my first question would be, what do you see as the biggest challenge or change to the mortgage process since the lockdowns began?
There have been some changes to some of the mortgage guidelines. Fortunately, it's a relatively small portion of the loans that are affected, but some down payment requirements and credit scores have changed. But for the most part, most people are still getting a loan. And, for some people, the biggest challenge is just adapting to doing this without meeting in person. We are able to do it totally paperless. And for most people, people love that, but there are some people that are kind of old school and kind of want to get together and, sign paper documents. And, they're kind of being forced into the new way of doing things, which is paperless. So
I hear that loud and clear.
Challenges.
So next question for you is, what is the minimum credit score that a buyer would need today? I believe that that's changed somewhat. So if you could tell me what it was and what it is now and how you see that going forward.
Sure. So the big change that we've seen has been primarily in the FHA market. So the main two types of loans that we do are conventional loans and FHA loans. And so prior to coronavirus, we did have a 580 minimum credit score for FHA. At the moment, and we work with quite a few different banks, most of the banks have raised their minimum FHA credit scores to 680. There's a few that are doing it with, it's pretty significant. There's still a couple banks that we work with that are doing 640 and 660, but they're not super attractive. So, typically, there are a lot of people who are pre-approved FHA that now have to update their pre-approval and see if it can now go conventional. Conventional is still a 620 minimum credit score. So if you have a 620, it's possible to get conventional approval, but not everybody with the 620 score is going to get approved. We look at the credit history, how many accounts they have, whether or not they've been on their job for a long time, if they have reserves, the down payment. All of these things affect whether or not the loan's going to get approved.
A little tapestry of financing.
Absolutely.
So what is the current interest rate right now? I know that tends to change minute to minute, day to day.
It does. Considering people may be watching this video, a week from now or 2 weeks from now, I probably shouldn't state a specific rate. It's also important for people to realize that not everybody's going to get the same rate. So the down payment and the credit scores do affect the rate, and we're seeing that's having a bigger impact. So if you have a lower credit score, you're going to see a different rate than somebody with a really high credit score. But generally speaking, rates are really good right now. They're, 30-year rates are in the threes, in some cases, mid threes or even low threes. So it's a really good time to get a mortgage. I mean, there haven't been too many times when they're much lower than they are now. And, that is one of the silver linings of this whole situation. Generally, when the economy's not doing well, it's good for mortgage rates. So that is one.
Okay, well, it's always good to have a silver lining to this dark cloud. And I think what I'm hearing is the more skin in the game, meaning the larger the down payment a buyer has, the better rate they'll qualify for. Would that be correct?
That is true.
Depending on all the other factors as well.
The credit score is probably more of a factor than the down payment.
Got it.
If you have a really high credit score, then you're going to get a really good rate regardless of whether or not you have a big down payment. But if you have kind of a mediocre credit score, then in that case, it has a much bigger impact. So if you have a mediocre credit score and you're doing 40% down, you're going to get a, if you have a mediocre credit score and you're only doing 5% down, then you're going to expect to pay a higher rate in that situation.
Makes perfect sense. All right, let's go to minimum down payments. What could a buyer today expect to need as a minimum down payment? And does that change depending on the type of financing that you use?
Sure. So, a lot of people think you need 20% down, and that's not really the case. Most conventional loans allow for a 5% down payment on loan amounts up to $510,000. There are some 3% down conventional options. If you're a first-time home buyer, you can do 3% down. Or if you, depending on your income, there's certain programs that are 3% down. FHA is 3.5%. There is a Connecticut first-time homebuyer program that does have down payment assistance that potentially you can do 100% financing. Although with down payment assistance, you're probably not going to get approved for as high of a price. So long story short, I would suggest to shoot for 3% or 5% down is a really good goal if you're trying to get ready to buy a house.
Okay, that's really helpful. Thank you. All right, next question. I get asked this a lot. How does employment factor into qualifying for a mortgage? In other words, if you've just recently started a new job, does that have a negative impact, or is it more a steady employment history? What if you're an independent contractor, or say you own a business?
It's a great question, and it's something a lot of people don't think about right away until they're going to get a mortgage.
Which can make things interesting, right?
Sometimes it does. So it's a little complicated, but I'll try and summarize it. It depends mostly on how you get paid. So the simplest or easiest loan to, I should say loan, but the simplest answer is if you are a salaried employee, or if you are a full-time, always working 40 hours a week, hourly employee. Those are pretty straightforward. If you don't really have to have a long time on the job, especially if you get a salary, we can actually close a loan before somebody even starts their job if they have an offer letter confirming the salary and their employment conditions have been cleared. So those are straightforward. Don't have to be on the job a long time for those. I mean, we do like to see a 2-year history of being working or in school. If you're changing jobs and you're in a similar line of work and you're getting a salary or you're getting the full 40 hours, that should be fine. Most cases. Of course, you want to talk to a mortgage professional about your specific situation. Now, where it gets a little more, some people sometimes don't qualify, has to do with people that have some kind of variable income. And that could be, if you're commissions or if you're working and not always working 40 hours a week, like if you work 32 hours a week and then you work 36 hours a week, those, or if you're an independent contractor, those are types of income where we have to take an average. So if you get paid commissions, we usually would average, take a 2-year average, or maybe we'd average this year and last year. So if it's going up, that's good. But what we're seeing is there's some people that during coronavirus are experiencing what we call low year-to-date income, meaning the average that they've made so far this year compared to the average that they made last year, this year is lower. So then we typically have to take a more conservative approach and use that lower year-to-date average if that's lower than last year. And for some people, that's okay. They may still qualify, but for other people, they may not. So that's why it's really important to update your pre-approval. If you were pre-approved, 3 months ago, the calculations might be different now if you have, if you're not one of those full-time salaried people. Does that make sense?
Absolutely. Question, I get this a lot. What is the difference between a pre-approval and a pre-qualification?
Yeah, so I mean, typically a pre-qualification has less information reviewed by the lender. Um, Different lenders have different standards for that, but typically, it's like a very quick, rough estimate. Maybe credit wasn't pulled, or maybe it hasn't been run through an automatic approval system. So what I try and do for people is for a pre-approval is to do a very thorough, doesn't take a long time, but to really kind of dig into the situation and really confirm how they get paid, how much money they have in the bank, how long they've been on the job. And we do the credit check and we put all the information into the computer system and we run it through what we call automated underwriting, which essentially is just a computer that reviews all the information and says that that loan is eligible to be approved. And that's the same computer system that our underwriters are using when they're actually doing a loan and getting a loan. So, a pre-approval is better because more information has been reviewed. So that's the better way to go.
Absolutely. And it always makes for a stronger offer because when you're reviewing from a seller's position, when you're reviewing an offer, when it comes in with a pre-qual, that means maybe it's good, maybe it's not. But when it comes in with a pre-approval, we know that this person has been vetted to some degree. So I know that's very confusing to a lot of people. All right. So I have a question for you.
All right. Hit me with it.
What happened today when there's a transaction? So you have a buyer that sold. It's actually the opposite. You have a seller that sold, a buyer that's buying, an offer on the table. And then before it gets to closing, the buyer has been either furloughed or worse yet, lost their job due to COVID-19. How does that get handled?
That's a really good question. And it is, an unfortunate reality that for some people that can happen. So, in order to use the income to qualify, the buyer does have to be, an active employee getting their regular pay. So a furloughed employee, we are not allowed to use that income to get approved for the loan. So, sometimes we have to get a little bit creative. I had somebody a couple weeks ago that did not think they were going to get furloughed. We were pretty far into the loan process, and then they did get furloughed. And originally, we were not using his wife's income to approve the loan because we didn't need to. So we just kind of had to switch gears and say, okay, now we're going to use the income from this other co-borrower that we weren't previously using. And it wasn't quite as much income, but we said, well, maybe if we have you pay off this credit card, we can make the numbers work. So, sometimes the loan just can't be done and has to be postponed until they're no longer furloughed. That's a possibility. Or in other cases, we just need to restructure the loan and figure out another way to get the loan approved.
That's when we all get creative.
Yeah, sometimes that's what you got to do.
Real estate interesting.
Yeah.
All right. So let's wrap up today with what would you say your top tips for buyers are? So if someone is interested in beginning the process of buying a house, what would you recommend they do so that they have themselves set up to be successful if they happen across a house that they love or a great deal that would kind of give them a leg up on all the other buyers that are out there?
Sure. So I would say that, it's important. It's to your benefit to talk to a mortgage person earlier in the process. It doesn't have to be a big deal or arduous, intimidating process. Get a recommendation for a good local mortgage lender that's in the business for a while, that knows what they're doing, and just tell them what you want to do and what your goals are. And make sure you've got everything lined up, because it is competitive out there. There's a lot of people that are interested in buying a home. There's not necessarily a lot of homes for sale. And so if you go out looking for houses and you're already pre-approved and you've already submitted your documents, and you find yourself in a situation where you want to buy a house and that other people are interested in, you will have an advantage of being ready to go. So that's my biggest suggestion, is just get started earlier. And if anything about your situation does change, let your mortgage person that you're working with know right away, so that they can update and, if needed, come up with a plan B.
All right. Well, Brian, this has all been amazing and just informative information. And I cannot thank you enough for your time and for your valuable expertise. I hope that you will join me again and give us an update as everything continues to unfold. And I want everyone to know, if you have any questions that we have not addressed, please don't hesitate to reach out to Brian or myself. I hope everyone has a wonderful day, and I'll see you soon. Bye-bye.
Thanks. Take care.
Bye.